Welcome back, guys. So today we are going to look at the concept of liquidity. This is lesson 3, and I'm going to teach you 2 specific levels you want to pay very close attention for your entries. These 2 levels happen on every single chart you look at. As long as it's a trend, you're most likely going to see these 2 concepts happen live on your charts. So the first has to do with fair value gaps. And take note, we are going to look at these zones on the 30 minutes. No other time frame. Stick to the 30 minutes for the LS model. Let's jump right into the chart so we can look at what fair value gaps are. And we look at the second liquidity level, which would be the last swing in a trend. First of all, let's define what a fair value gap is. So a fair value gap is a gap as a result of an impulsive move in the markets. It happens when the wick of the first candle does not overlap with the wick of the third candle, leaving behind a gap between those 3 candles. Now, what price usually does is it comes back to that fair value gap, and then you're most likely going to get a reaction from that fair value gap. Fair value gaps happen almost every single time. What separates a beginner trader from a pro trader is how he's able to identify the gaps that price is most likely going to react from. So now let's look at a bearish example of a fair value gap. So right here, you notice that we had a bullish candle, an aggressively bearish candle, followed by a third bearish candle. So if you notice, the wick of the first candle does not overlap the wick of the third candle, leaving behind a gap. Now I marked this gap out on the 30 minute. Take note of that. I'm marking these gaps on the 30 minute. Now what do we see? Price retraced into that 30 minute gap and then it pushed out. Usually gaps can be respected more than one time. So you can tell that we tapped into it and bounced away. We tapped into it a second time and bounced away. We tapped into it a third time and then we had a final move out. And I think, look right here. So we had even a 4th touch right here. We touched it the 4th time and then it bounced out. So fair value gaps happen all the time, and this is a concept you need to understand. I was thinking about a way to explain this to you so that you guys can kind of understand why we have these gaps. Imagine, there's this lady who goes to the farmer's market and she wants to buy apples. She has $100 and she wants to buy $100 worth of apples. Now she goes to the vendor and the vendor says, hey, I only have $50 worth right here on the counter. The $100 is a big order, but I can't give you the $100 worth if you allow me to go back into my truck to get the additional cart with the additional $50 worth of apples. The salesperson told the lady that, okay, so I'm going to take your money, but just go ahead, go do your shopping, and by the time you return, I would have your apples. The same applies on the flip side. Let's say the woman comes and she doesn't want to buy apples, she wants to sell apples worth $100, but the salesperson says, okay, that's fine, I have only $50 on me, I'm going to give you the $50 and I'm going to take the apples. Okay, go do your sales. When you come back, I would have the $50 to give to you. So think about that. Think about this example I've given you in relation to fair value gaps. When there is a very big order in the markets, you're most likely going to see that impulsive move. That is the indication that there is a huge order in the markets. So what happens? Eventually, the lady is going to come back to take the value. She dropped $100, but she got only $50 worth of apples. And she came back to take the $50 worth of apples before she could leave the market. When you think about fair value gaps, think about this example I've given you. These are huge orders that come into the market. The market has to come back to fulfill those orders. Now I'm going to teach you how to mark out your fair value gaps. All right, so as you can see, we broke this high and then we pushed up and we had a kind of like a small retracement. You can tell that this was an extremely bullish market and then we pushed up again. All right, but let's look down here. Let's look in this area. In the move up, right, we left a fair value gap. This was a fair value gap that price left behind on the 30 minute. Okay, so this is what you should be interested in. There's also another fair value gap right here. This is also happening within the leg. Let's mark another fair value gap. There is another one right here. Okay, so these are all 30-minute gaps that have created a push to the upside. Now the question is, which of the gaps are you interested in? Ideally, the gap I am interested in is the gap down here. Why? Because that is the first gap that was created, is one of the most significant gaps. Number 2, the gap needs to sit inside the 50% or below the 50% mark for me to consider it. So if you look in this move up here, we have the 50% up to this particular high. Imagine we didn't know what was happening here. We didn't anticipate that pullback happening here. We would see this fair value gap, but we would ignore it. We would actually be waiting for price to get into this or this one, because why? This particular fair value gap is sitting between 50% of the leg, and this one is even sitting below. So I anticipate that we either come down here or we come down here. There are certain scenarios like you're seeing that price could be so bullish and price could be so aggressive that price is not going to come down all the way here. It's going to continue pushing and continue creating new highs. And when you have new legs, like here, for example, you had a pullback into this particular gap and you had a new break, you again mark the new fair value gaps that are formed. Right here, you can tell that we had a new fair value gap sitting right here after we broke this particular high. I'm going to mark this out in green. So now as price keeps moving, you also need to dynamically be marking out your fair value gaps to see which would be ideal for price to pull back into. Now here, you can tell that we had a new leg from this high. So all you need to do is to mark the chart with your Fibonacci from this particular low to this particular high. And then you're able to tell where 50% sits. So this is the move up and this is 50%, right? So you can tell that this fair value gap square, it sits 50% inside the leg. And it's perfect because that is literally the only fair value gap that was created. And what do you see? It's not magic. What do you see? Price wicked into this gap and then boom, it continued pushing. So this is how you mark out your fair value gaps. Now, a fair value gap that happens directly after the swing, a high probability fair value gap, and price is most likely going to react from them. So let's look at a bearish example. So here you can tell that we had a swing and price comes back to break this particular low. So we have a change of character right here. Now in the move down right after the swing, what do we have? We have a 30-minute fair value gap here. So what are we waiting for? We want price to retrace into that gap. As long as it sits below 50% of the move down, this is a high probability fair value gap. Now I take my Fibonacci mark from this particular high to this particular low, and where does 50% sit? This is 50%, right? And the fair value gap sits up here. Now if we are bearish, we want price to sit above 50%, which is what is called premium, right? Now if we are bullish, 50%, price below 50% is called the discount zone. So if we're bullish, we want to buy from the discount zone, and if we're bearish, we want to buy from the premium zone. And what do we see? Price pulled back all the way into that fair value gap and then reacted nicely in the opposite direction. So let's talk about the second liquidity level, which is the last swing. I call it the last swing. Now this is the last swing before a break of structure. So let's see how it looks right on the charts. In a scenario where you're seeing multiple breaks of structure to the downside, let's mark out this break. Let's mark out this particular break as here as another break. What I want you to be picturing in your head, in your mind, is as price keeps pushing down and keeps breaking lows, you want to be marking out the highs, right? And take note of how I'm drawing this, how I'm marking this. You can tell that I'm marking from the bodies, the bodies of the highest price to the wick. Okay, so this is one level that I've marked, but all you're interested in is the last swing. So let's say you don't have an idea what is going on here. Let's use the replay tool. You don't have an idea. So you keep marking out the last swing. So we have a last swing right here. We have a last swing right here. So you can tell these are the swings, right? From the bodies to wick. Now, the last swing is a very, very, very significant liquidity level because usually when price is trending, there's a high probability that we're going to take out this high before the move continues. So I want you to go to your charts, go mark out the last swings and see how price reacts from them. As we continue to step down, we continue to leave fair value gaps in premium. We continue to react down, continue to break structure, and we also continue to leave fair value gaps in premium in this leg as well. But I want you to take note because in the next lessons, I will be explaining to you the concept of risk and managing your risk, because in certain cases, these fair value gaps might be run through. So you would be looking at what happens here. So for example, price comes in here, it gives you a reaction to take a trade on the lower time frames. You take it and that stops you out. The next level you're interested in is what happens when price gets into this area, okay? But usually on the lower time frames, if price gets to this fair value gap, for example, on the lower time frames, there would be signs that this would fail. I will be taking you through those entry models in the next lesson. So when price gets in here, you don't just buy or you don't just sell just because price is in that zone. You want to wait for something specific to happen before you take your entries. Let's play price and see what happens. So we push, we run through this fair value gap right here, and then what? We keep pushing. You can tell that this is still bullish structure. We keep pushing, and then what do we see? We take out liquidity at this high. Now, I want you guys to look very closely at what's happening here. So this is liquidity. Let me mark this out as liquidity. Now, what do you see? When we took out this high, what do you see? You can tell that we do have a fair value gap sitting right here. Price never ever tapped into this particular fair value gap. So what do? We did two things. Now we've tapped into this particular last swing that I've told you about as a very significant level of liquidity, and we've also tapped into a 30-minute. So these two are, the stars are kind of aligned for you at this point. But the thing is, you don't always need to have both of them to take your trade. As long as on the lower time frames you're getting the particular entry you're looking for. So in this case, stars are aligned. We've actually taken out the last swing and we've tapped into this particular fair value gap. So on the lower time frames, we probably get an entry model from here to take price lower, right? This is going to be like a super high probability trade because all the stars are aligned. So let's click play. Let's see what happens. You can tell immediate reaction, right? Immediate reaction. We bounce back into that gap, another aggressive reaction, and the rest is history, right? The rest is history. We push down. So people would ask, why did we not do a lower low, a lower high, a lower low, a lower high, and then continue to do a lower low? Because they don't simply understand the concept of liquidity. Now, when you do understand that, and as I've explained to you, you do know that price wants to take out liquidity before it continues to move in a specific direction. And another lesson I've taught you guys is that usually gaps might not always be respected. Your gaps might not always be respected. So if a gap is not respected, you need to look at what is above the gap to see where price might be reaching for. Now here, again, repeating it so that you guys can remember, we had a swing high, which was the last high before we broke this low, high liquidity, and above that, we had a fair value gap. Okay, so this was multiple confluences that align. Now take note, another thing I need to be mindful of is when you have a fair value gap and price has not tapped into it, we call that an unmitigated fair value gap. Usually when price taps into it and at least closes like 50% of the level, we call it a mitigated fair value gap. Some people treat this differently. Some people would say as long as price moves through that gap entirely, then it's mitigated. But for me, I do want to see price come to at least 50% of the level before I call it mitigated. So same way, for example, somebody comes to the market, they want to buy 100 apples, or they want to sell, in this case, this is a bearish example. So let's say they want to sell 100 apples. So they come here, they give the vendor the money for the 100 apples, but the vendor says, hey, I don't have 100 apples, I have only 50. So you can go do your rounds, all right? When you come back, I would have the remaining 50 apples for you. Okay, so the lady went to do her shopping, and then she came back to take the rest of her 50 apples, right? And then she leaves. Does that make sense? That's cool. So again, I repeat, the levels can stand alone on their own, but if you have them stacked up, then it increases the probability that the setup will play out. So in the next lesson, we're going to look at the continuation model and the bias flip model, and these would be happening on the lower time frame. So again, go back to your charts, go look on the 30-minute, mark out all the last swing highs and all the fair value gaps, and just study what price does when price gets back to those levels. I'll see you in the next video.